Hi, good afternoon, and thank you for joining us today. My name is Oscar Valdes Viera, the Private Equity and Capital Markets Policy Analyst with Americans for Financial Reform. For those of you that don't know, Americans for Financial Reform is a nonpartisan and nonprofit coalition of more than 200 civil rights, consumer, labor, business, investor, civic, and community groups. And AFR was formed in the wake of the 2008 financial crisis, and it aims at transforming the financial system so that it serves an equitable and sustainable economy. First, I want to thank our 6 speakers today. They are really the perfect lineup to cover our topic today. I will introduce our speakers when it's their turn, and we will hear from them for approximately 5 minutes each. I will now talk a little bit about why we're here and give some quick general context and framing, and then I'll pass it to our first speaker. As I said before, Americans for Financial Reform aims at transforming the financial system so that it serves an equitable and sustainable economy. That includes confronting the private equity industry, including the industry's latest attempt to try and raid people's retirement savings. This could have serious consequences for millions of workers and for the stability of our financial system and our economy. Trump is expected to issue an executive order. We are now hearing rumors that it can come as soon as tomorrow, and this will open the door for private equity to get into individual 401k type of retirement accounts. For decades, federal rules have encouraged workers to put money aside in 401k plans that allows them to build wealth over decades and to have economic security in retirement. These investments are supposed to be transparent, liquid, and reasonably priced in assets or accounts like in mutual funds, index funds that provide security and stability. The upcoming executive order would be a break from those principles, and it would be inviting Wall Street's most predatory actors into people's savings accounts. It would be a huge wealth transfer from retirement savings to private equity firms that could put everyone's retirement security at risk. Private equity firms have long thrived in the shadows. They profit by buying companies, using a lot of debt, imposing onerous fees, and often leaving workers, suppliers, and local communities to deal with the fallout. They have grown wealthy operating in private markets, which lack the transparency and the investor protections that define public markets. Historically, one of the biggest only the biggest and most sophisticated so-called accredited investors, like wealthy families and large institutional investors, such as pension funds and university endowments, were able to invest in private equity. And there was a good reason for that. Investments in private markets and in private equity are illiquid, are hard to value, and are riddled with hidden fees and risks that even the most sophisticated investors struggle to navigate. This executive order is really about bailing out a struggling private equity industry. The fundraising has stalled. Something around fundraising is down over 35% in the first quarter of the year compared to the year before, and distributions to investors have plummeted. And some of the core investors in private equity, the big institutional investors like the university endowments and the pension funds, are headed for the exits because of the high fees, the opaque reporting, and the disappointing returns, which we have documented in a recent paper that we released last week, and we can put in the chat. And regulators around the world are also warning that private credit, which is the booming lending made by and for private equity, is also very opaque and is potentially unstable. So in short, the industry is struggling to keep its money machine running. So where do they turn? They turn to the $12 trillion sitting in workers' 401ks. Wall Street sees ordinary retirement savers as the perfect targets. It's a captive capital, unable to negotiate for better terms that they would be offered, and with little bargaining power or ability to demand real transparency. These retirement savers can become the industry's dumping ground for risky, overvalued, and hard to sell assets that institutional investors no longer want. So, yeah, this is very dangerous for individual savers. Private equity investments are very liquid, meaning that you cannot just cash out when you need money for a down payment or a financial emergency, a loss of a job or something. Their valuation are largely set by the fund managers themselves with very little independent oversight. And all of this means that your 401k balance could be based on a number that's more fiction than fact. Retirement plan administrators have long avoided private equity because of fiduciary concerns, meaning the legal duty to ensure that investment options in 401ks are prudent and in the best interest of participants. This executive order would turn fiduciary duty on its head and give the green light for private equity to slip into default 401k plans without proving beneficial for workers. It's basically a big gift to Wall Street and nothing for the millions of people who rely on these accounts to retire with dignity. So this is all what we're going to be discussing today. We'll dig deeper into why private equity is making this push now, the risks it poses to individual savers and to the broader economy, and what actions the Department of Labor and the Securities and Exchange Commission should take in response. And we will hear from experts who have studied these issues and understand how private equity model works in practice. So thank you all again for being here today. And now I will pass it to our first speaker. We'll start with Professor William Birdthistle. Thank you so much for being here today, Professor at the University of Chicago Law School, where he focuses on investment funds, financial regulation, and corporate governance. And prior to joining the University of Chicago, he was director of the Division of Investment Management at the U.S. Securities and Exchange Commission. Professor, thank you very much for being here. Could you give us some context on the state of the industry and the big picture, policy context that has allowed private markets and private equity firms to balloon so much?
Certainly. Thank you so much for the invitation, Oscar. Yeah. The basic premise of the securities regulations in this country are that if you would like to sell your securities or your investments to the average American public, then you need to disclose a lot about what you do. And there's been a long, rich tradition since 1933 and 34 and 40 of requiring comprehensive, large registration documents that provide all that information to the investing public. What makes private investment private is the ability to do that without being a public company. And it's clearly an exception to the general rule. Where do those rules come from? Well, the Securities Act of 1933, the Securities Exchange Act of 1934, and the Investment Company Act of 1940 were all born out of the Great Depression. And obviously things went very pear-shaped in the late 1920s in the United States. I think many people are aware of how securities can be missold and how the public stock markets can be rendered dark if companies aren't providing information about what it is they do and how their investments are performing. I think the average investor is a little bit less clear about what happened with investment funds. And throughout the 1910s and the 1920s, investment funds were a particular kind of instrument in which some professional managers oversaw and had managed the money of other investors. That's what made them investment funds instead of ordinary companies. And in so doing, they were able to capitalize and to engage in a great deal of self-dealing and a whole variety of other practices that Congress and the United States found appalling and tried to regulate with the Investment Company Act of 1940. So most funds these days, be they funds that average people invest in, money market funds, mutual funds, exchange-traded funds, or be they the kind of investment that we're talking about here today, private funds, such as private equity funds, hedge funds, or venture capital funds, those pools of money serve as collective investment vehicles in which investors give their money to an investment manager, and that investment manager develops a portfolio of investments. And then the idea is relatively straightforward. Using that war chest of money to invest in fruitful investments, the whole pie grows larger, and everyone with an investment in the fund is made richer by doing so. Again, I think the average American is familiar with that process because through IRAs and 401ks, most of us are given an investment menu to expose ourselves to relatively vanilla versions of this. Mutual funds, exchange traded funds, and money market funds are very common. They're also public, which means that they're regulated extensively to do two things. First, they have to pump out a great deal of information in their registration statement about what they do. Then, second, they have to produce an ongoing series of information about what their investments are and how they're performing. But what's different about the 1940 Act, the Investment Company Act of 1940, is that in addition to requiring disclosure, it also requires some certain mandatory command and control type regulation that specifically says things like these funds cannot invest with a certain degree of leverage. That is, using borrowing to magnify the returns and the risks of the funds. They cannot sell short or engage in particular kinds of exotic trades. Why did Congress do that in 1940? Because Congress concluded that for the average investors attempting to save for their retirement and entrusting their life savings to others, that process should be as safe as Congress can make it. Now, what has private fund investing been doing for the last several decades? It's been structuring itself to escape, to avoid the regulatory reach of the 1933 Act, the 1934 Act, and the 1940 Act. And in so doing, as Oscar said at the top, they're largely opaque to the average investor. We don't necessarily receive things like a registration statement that tells me tells any investor who's investing, what the business model is, what the returns are like, and some of the other provisions that Oscar also mentioned. That makes them very opaque. In fact, they're really quite dark. Now, it's common in many regulatory spheres for there to be a general rule and then an exception. Typically, exceptions are for things like de minimis exceptions. What's remarkable about this space is the degree to which the exception is, if not swallowing the rule, then growing as large and massive as the rule. So the American capital markets are enormous, the world's largest. Private funds these days, again, specifically hedge, private equity, and venture capital, now comprise a total of almost $31 trillion. Public funds are barely more than $39 trillion. So these two markets, one of which was meant to be an exception to the other, are almost at parity now. And private fund markets are growing at a much, much more rapid pace. Why is that, one might ask? Well, part of it is the decline of IPOs. Companies in this country are going public a lot less frequently than they used to. There used to be something on the order of 7,000 public companies, and now there's something on the order of 3,000. And part of it is because investors, the people managing these funds, are content to operate in this darker, less well-regulated, less well-seen space. It's also leading to a great deal of concentration in this space. So we end up with now a context where there's massive amounts of money in these private funds. And as I say, the exceptions almost swallowed the rule. Why is that an issue now? Again, as Oscar mentioned, while the party was going well and while these funds were succeeding, there wasn't much of an appetite or an interest in making them available to ordinary investors. Indeed, the basic premise of being private requires that you either offer your investments only to very sophisticated investors or only to a very small number of investors. And as Oscar said, that's typically and historically meant sovereign wealth funds, university endowments, massive public pension or private pension funds, insurance funds, or very high net worth individuals. But now that there's difficulty in the space and a challenge with raising additional money and exiting from these investments, now the managers are actually quite enthusiastic about making these investments available to people that they once shunned. And I think as a general rule, it's probably worthy of being suspicious about a club that now all of a sudden wants to welcome you to the party.
Thank you so much, Professor. And Professor Renee Jones just joined now. Thank you so much for being with us, Professor. Professor of Boston College Law School. Her scholarship covers securities regulation, financial regulation, corporate governance, and federal-state interactions. In between her posts at Boston College Law, Professor Jones served as director of the Division of Corporation Finance at the U.S. Securities and Exchange Commission. Thank you so much for joining us today. I wanted to give you a chance to give us some more of your perspectives on the big picture context on the state of the industry and how private equity has gotten to where it is today.
Okay, great. I'm so happy to be here to talk about this topic. And what I'm going to do is just review some of the data and give some context to the comments that William Birdthistle made. And I'm also going to talk about the legal developments behind the trends in the growth of private markets. So public markets are shrinking and private markets are expanding rapidly. And the number of public companies has dropped from about 8,000 at its peak in 1996 to only 4,300 today. And we also see that the number of IPOs per year is falling. The peak in 1996 was 706 IPOs, and we had just 225 last year. There was a boom, an IPO boom in 2020 and 2021, where we saw 480 and 1,000 IPOs. But that was kind of a reflection of the COVID bubble, a low interest rate environment, and a very short-lived SPAC boom, which accounted for more than half of the IPOs in those years. So now we're, like I said, we had 225 only in 2024, and so far this year we've seen 124 IPOs. So another trend is that startups are staying private for much longer than they used to. For tech-based startups, the median age at IPO was 7 years back in 1996, and it's increased to 14 years today. So we're seeing the number of unicorns, which are private companies worth $1 billion or more, increasing from 42 in 2013 to 1,500 today, with an aggregate valuation of $4 trillion. So the public markets clearly are shrinking rapidly and private markets are expanding. More money has been raised in private transactions than registered public offerings for each of the past 12 years. So, why is this happening? It's private funds, clearly. Private funds have grown from a very small slice of the industry in the 1970s and now trillions of dollars of assets, and growing really rapidly from just 1 trillion in 2000 to 10 trillion in 2012 to 26 trillion in 2022, and now $30 trillion of assets managed by private funds. That includes private equity, hedge funds, and venture capital funds. So the conventional story behind all of this shrinking of public markets and the growth of private markets has been that it's because of excessive regulation, the high costs and the delays that are associated with IPOs and the burdens that are associated with public company status, which of course people say were exacerbated by Sarbanes-Oxley and Dodd-Frank. And this was discouraging companies from going public and driving public companies to go private. But legal scholars and finance scholars have largely debunked these theories, and instead they point to other very important legal developments that haven't gotten a lot of attention. So I'll just mention 3. There was a 1979 ruling by the Department of Labor, and that really opened the door for pension funds to begin to invest in private markets. So private equity, venture capital, and hedge funds all grew very rapidly after this change. The next big change was in 1996 with amendments to the Investment Company Act, which eliminated the 100 investor cap on private funds. And again, the size of private funds really ballooned after that change. And finally, in 2012, the Jobs Act increased the number of shareholders that compels a private company to make public disclosures from 500 shareholders to 2,000, and also excluded employee shareholders from that count. So it was this change in the law, in combination with all the money that was flooding into private funds, that means that private companies can meet most of their funding needs without tapping public markets and can stay private indefinitely. So I'll just take 1 minute to discuss some of the challenges that are now facing the PE sector, and I know William alluded to them. I attended a conference in London in June on private capital and private equity and venture capital, and many of the speakers there focused their remarks on the difficulty that private fund managers are having exiting their investments. And the PE managers in particular are very concerned about the increasing number of long-aged companies in their portfolios that haven't achieved an exit. And according to PitchBook, more than 30% of PE-backed companies have been held by their fund managers for at least 5 years. And that's the highest percentage in nearly a decade. So if PE funds can't exit their investments, they can't return capital to their investors. And this is making it very difficult for them to raise new funds because their existing investors are still waiting for the return of the capital from their prior investors. So that's why we see the largest US PE managers looking to sell their products to retail investors as a solution to this no exit dilemma. $12 trillion of assets are sitting in 401k plans and other similar retirement accounts. And if PE could just get a slice of those assets, that would go a long way to replacing the funds that are being held back now by their traditional investors, which are pension funds, foundations, and university endowments. Now, not a lot of the PE managers are not actually enthusiastic about this effort, and many limited partners are also on edge. They view that selling PE investments to retail investors could create significant operational and also reputational risk for PE managers. So I'm going to stop there and have the fellow panelists talk about why PE investments probably are not appropriate investments for retirement savings plans.
Great, thank you so much, Professor Jones. So now if I can invite Professor Birdthistle again, and just to talk a little bit more about the private funds advisor rule that the SEC adopted a couple of years ago and that was struck down by the courts, and what were the concerning industry practices that compelled the SEC to put out that rule, and just a big picture of why retail investors would get very low quality private market investments. Professor Jones was saying, private equity is having a hard time exiting some assets, and why would retail investors be that off-ramp that they are looking for?
Certainly. Thank you again, Oscar. Yes, it was a big initiative when Renee and I were at the SEC to see what could be done with the existing set of authorities that the agency has to protect investors whose money, either directly or indirectly, is being invested in private equity, hedge, and venture capital. And a lot of that money is coming ultimately from individual investors. So, for instance, $30 trillion is what Professor Jones just mentioned about the total value. Many of the pension funds that I mentioned are comprised the retirement savings of firefighters, school teachers, and so forth across the United States, and it's their money that's being invested. So the Commission's concern in August of 2023 was that given some of the practices that were prevalent in the industry, there could afford to be a great deal more protection of that money. And so using authority that had been put in place in 2010 through the Dodd-Frank Act, the Commission passed a quintet of rules, 5 rules. And like a lot of things that you see in law and contracts, when you see rules or new provisions, it tells you a lot about the kind of practices we had been seeing beforehand. So let me quickly skim through those 5 different rules. And then as you mentioned, Oscar, I'll talk a little bit about what we can kind of expect to see with the investments made available to retail investors. So the first rule would have required that all private fund advisors, anyone managing a fund, a private fund, be required to provide a quarterly report by the general partner, that's the manager of the fund, to the limited partner, those are the investors, detailing the performance, the fees, and the expenses of the fund. So that's it. That's it. Not to the public. That information doesn't need to be made to the public. It doesn't need to be made to the SEC. It just needs to be made from the fund manager to the fund investors. Tell us what the performance is, the fees are, and the expenses are. That was rule number 1. Rule number 2 was requiring an annual audit of all the private funds. So as Renee mentioned earlier, and as Oscar, as you said at the top, it's very difficult to know how much money should be coming out of a fund as compensation if you don't know how big the fund is. And since a lot of this is so private, it's quite difficult to actually know. In a public fund, it's quite easy to check. If a Fidelity fund, for instance, owns 100 million shares of Apple, we can all count the 100 million, multiply it by the price of Apple today. Very difficult to do that in an opaque private fund. So an audit would be the solution to that. The third rule was to require that the general partners, that the managers of funds, get a fairness or evaluation opinion from an independent third party anytime that advisor proposed buying out a fund to continue it. That's a common practice. It's called an advisor-led secondary, where a fund is coming to the end of its life and the manager of the fund extends it by buying out all the assets and continuing them for another 5, 7, 10 years. But if you're buying the assets that you control, there's obviously a massive conflict of interest there, since you're both agreeing to the price and setting the price. And the Commission's suggestion for curing that would have been to require an independent fairness evaluation opinion. The 4th and the 5th rules both said the following practices are impermissible unless the investors vote and agree to it, so unless they consent, or unless the manager running the fund discloses this upfront to the investors. And again, these sort of tell you the kind of practices that the Commission had seen and was concerned about. So under the 4th rule, a manager would be prohibited from doing any of the following without disclosure or consent. Charging the fund for sanctions that come from investigation. So if a fund was run poorly and accrued sanctions by a prosecutor, the manager would have to pay it unless they got consent or disclosed to the investors to do that. Similarly, with charging the fund for compliance fees. Same for allocating fees to the investors in a fund on a non-pro rata basis, not doing it equally across the investments in the fund. Why might they do that? They might choose to give a sweetheart rate to some of their investors at the expense of other investors. And finally, borrowing from a fund. So if the manager of the fund decides to use the fund as a piggy bank, what this rule would have said is that's not permissible unless you disclose it or you get the consent of the investors. And then in the fifth rule, similar idea, but with two particular areas of focus. So the fifth rule said that, again, if the manager of a fund doesn't receive consent or give disclosure, then it's prohibited from doing the following: offering specific investors in its funds preferential treatment with respect to information or redemption. Now, that sounds a little bit technical, but it's easy to understand if you figure out what exactly is happening in those circumstances. So private funded managers are very happy to attract large investors to their fund, possibly by giving them sweetheart agreements and side letters. And a classic one, and the most powerful one they could give, is to say to the largest investors, we will both tell you more information about what the fund is doing and allow you to leave the fund before other people. You can see what the problem there might be if a fund is running into trouble and it's got a series of investments that are looking bad or like they're going to have poor prospects. And that large investor can get to the head of the queue to get out the door quickly. If you combine preferential information with preferential redemption rights, all your big investors are going to run out the door anytime something bad is about to happen. And all the smaller investors, and this is smaller amongst large institutional investors, but obviously would be true with retail investors too, they're going to be left holding the bag when things go badly. So that was the quintet of rules that the Commission passed in August of 2023. 7 days after those rules were promulgated, trade associations for the private fund industry sued the agency in the Fifth Circuit using a trade association, a new trade association that they had set up in the Fifth Circuit for that purpose. 10 months later, the Fifth Circuit Court of Appeals struck down all 5 rules, even though it only considered 3 of them. And what was most interesting about that, the rules were written in about 650 pages, and the opinion striking them down was in about 20 pages. And what the court said when it struck it down was this authority that the commission was purporting to use under Dodd-Frank applied only to retail investors. And therefore, it wasn't applicable to the private fund industry because the private fund industry doesn't have any retail investors. Now, of course, that's foreshadowing a bit of a punchline, which is we're here today because of the industry's concerted push to make sure that private fund investments are widely available to retail investors, which makes one wonder, since all of this happened in 2023, 2024, and now it's 2025, was the fund industry making arguments that there were no retail investors at the same time that they were planning very much to make these available to retail investors? On your second question, Oscar, about what should we expect to see with the kind of private fund investments that are ultimately made available to retail investors, I just remind everyone of how private fund investment does. The answer to that is actually quite difficult to figure out. Most people take as a premise that private funds do better than alternatives in the market, that they do better than the market overall. That's why we hear people so excited about getting access to hedge in private equity. There's actually almost no conclusive scholarly work that demonstrates that. There's lots of information pushing in both directions about whether that's true. Warren Buffett once won a famous bet arguing that it wasn't true because he challenged a hedge fund manager to outperform the S&P 500 and they didn't. One thing that all of us should bear in mind is that to the extent that private funds are made available to retail investors aren't going to be getting exposure to the overall private fund universe. They're going to be getting exposure to a certain segment of that. And it's fair to assume that it's going to be one of the weaker segments. It's either going to be the bottom half of those investments or the bottom quartile. They're not going to be getting the good stuff. So that's a final concern in this space. No one is suggesting that private fund investments are going to be made available on an equal basis to retail investors. Clearly, the biggest investors will still get the best investments, and retail will get whatever's left at the bottom. So the good news, if there is some from this overview, is that to the extent that retail investments do proliferate in this space, then presumably the authority that the SEC had to pass these rules once upon a time will be resuscitated, and a future SEC may be able to revisit them and pass similar rules, though not without a great deal of angst in the meantime. Thank you, Oscar.
Thank you so much. Well, yeah, lots of interesting stuff there. We'll We are running a little behind on time, so we'll keep going now and then come back for questions. We are also pleased to have today Ali Khawar joining us. Ali has previously served with the U.S. Department of Labor under both Democratic and Republican administrations. And during the Biden administration, he was the Principal Deputy Assistant Secretary and Acting Assistant Secretary of the Employee Benefit Security Administration, the agency responsible for overseeing the over 4 million retirement, health, and other job-based benefit plans that serve American workers, retirees, and families. Ali has also served as a bureau member for the Organization for Economic Cooperation and Development's Working Party on Private Pensions and the Vice President of the International Organization of Pension Supervisors. And more recently, he founded FCP LLC, a company that offers strategic and benefits-related consulting. Ali, thank you so much for being with us today. Our question to you is, what is ERISA? And why have plans governed by ERISA mostly not included investments in private markets and in private equity in particular? And, I'll just throw out there, if you can cover a little bit of what had happened on this issue on previous administrations, and what do we expect now in Trump 2.0 DOL.
Thanks, Oscar. Thank you for the invitation, and good to be here with everyone. So a lot of ground to cover. Let me try and get through it as quickly as possible. Let me start with ERISA. So ERISA is the federal law that governs private sector employment-based retirement plans and other kinds of benefit plans. That's a mouthful. So the easier way to think about it is the law that governs things like 401ks, the retirement benefit that you have as a result of your working at an employer. An important thing to know about ERISA is it is really centered around two concepts, individuals that are called fiduciaries and the obligations that they have. And the way to think about that is that you have these individuals that are responsible for really important decision-making. They're deciding, for example, what is on the lineup of your 401k, what you can invest in. And those individuals are charged with very high legal obligations. They have duties to make sure that they're looking out for your best interest as a saver, doing things like trying to maximize your risk-adjusted returns. So these are critically important obligations that fiduciaries have. And it actually goes squarely, Oscar, to your other question about why have they not invested traditionally in private markets in the 401k universe? Because I think there are a number of factors here. We've heard a lot from the other speakers already about some of the challenges around private market investments in general. And I just want to add a couple of things to that. The first is that these fiduciary obligations, again, are very, very important. They're taken very seriously, and there's legal liability associated with making the wrong decision. So that serves as a little bit of a check and prevents people from kind of too easily just jumping into something that may not be appropriate. There are a couple of things that you can think about, though, that are pretty problematic in the 401k universe when you're thinking about, and I'll just use private equity as an example. So in a 401k, it is really important that you have liquidity, which is not a thing that you would associate with private equity. So for example, if someone retires, you can't say, look, I need 6 months to sell these assets that are in the private equity holding. So would you mind not retiring right now so that I can actually redeem all your money? Like, that wouldn't make sense. Similarly, if someone's leaving employment and says, I want to take my 401k assets and I want to roll it over to my new employer's 401k, you can't tell them, like, oh, you know what? I need a little bit of time because I don't have the liquid assets right now. So this liquidity concern has been really, really, I think, front and center for fiduciaries when they're looking at this. But again, I mean, the concerns that we heard about the transparency, the complexity, the high fees relative to what you're getting, and the uncertainty around the returns, those are also factors that are in the minds of fiduciaries that have stopped them maybe from jumping in as much. There's one other that I just want to make sure I pull out, which is the comparability. Because when you're making that decision as a fiduciary, one of the things that can be quite hard when you're looking at private market investments is to figure out, if you're choosing between investment option A and investment option B, how can you think about, what the fees compare to, what you're actually getting for those fees, what the expected returns are, because you don't have that same kind of standard framework that really pushes comparability that you would see in the public markets. It can be a little bit more challenging to make that decision and to make sure that you're making the right educated, appropriate decision for the savers that you're charged with looking out for. So I want to talk a little bit about what you've seen in prior administrations on this issue. And I'm not going to go back over the 50 years of ERISA. I'll start with Trump 1.0. In the first Trump administration, the Department of Labor issued what's called an information letter. It's a kind of guidance that the department issues. And in that letter, it talked about the appropriateness of private equity. And the question that was asked was really, it was kind of can I invest in private equity in the DC context for part of a managed account kind of structure? The structure is not really important. The big picture question was, is private equity appropriate? The answer that the department gave is yes, private equity can be appropriate. I'm not necessarily quibbling with that. The important part to know about the Trump 1.0 decision and guidance that they issued is the additional stuff that's in there. There were a lot of uncritical kind of recitations of industry talking points about how good private equity is. And the really sense that you got is kind of, come on in, this is a winning investment for people to get into, without thinking about when it might not work. So in the Biden administration, we didn't repeal that guidance entirely, but we did replace it and supplement it with additional guidance. And in our additional guidance, we were really cautioning people that they should not read too much into that Trump 1.0 guidance. They shouldn't view it as saying that this is an appropriate investment for everyone all the time, that some of the recitations needed to be viewed with a little bit more of a critical eye. And you needed to think about, what the context is and when this was going to be appropriate, when it was not. In particular, there's a question, this isn't regulatory speak. This is not what you would see in the guidance, but the core question was, do you really know what you're doing when you're getting into this investment? That is a really important question for fiduciaries to ask themselves. And there was a pretty significant contrast between the entities that came in the first Trump administration, which were the kind of pension plans that William was talking about earlier, right? They're very sophisticated players. They are already doing this in other parts of their portfolio. They have a lot of experience. And now they're thinking about doing this in a little bit of the DC portfolio in a kind of controlled way. And you could have confidence that they understand the tires that they need to kick and what is or isn't going to work. That is very different if you think of an employer that has maybe 30 people that is now being pitched this kind of asset and being told that this is really a good thing. And so that kind of context was very important. Another part of what the department emphasized in the first Biden administration, in the Biden administration, was the importance of the kind of disclosures that you're giving to participants, the individuals that are saving. So if this is something that's now on the lineup, how are you making sure that the individuals that are choosing whether or not to save in this particular investment vehicle, that they understand what the risks are that they're taking on, what they're potentially getting, what they're potentially losing, and how can you make sure that that disclosure is done very appropriately and in a manner that's kind of clear for them. We haven't seen yet the executive order, and I'm anticipating that the executive order, whenever it comes out, will ultimately, the bottom line will be it'll direct the SEC, the Department of Labor, to take further action. So without the benefit of having seen those, I want to talk a little bit about some of the questions that I have in my mind and some of the things that are important to look for, I think, in this context. I mean, I think the first is to just say at the outset, we have, to be pretty blunt, we have an administration where billionaires and millionaires are making decisions about the savings of everyday Americans. And I think against that backdrop, it is fair to say that they haven't really earned the benefit of the doubt. Now, private equity, other private market investments may be appropriate in certain contexts, but the context really matters. And so one core question is, to what extent is the guidance that ultimately comes out of whether it's the SEC, the Department of Labor, or even the executive order, to what extent is this returning to that sense of the only way to lose is to not be playing in this, particular pool? That's not really an appropriate position to take, because there are any number of contexts that you can come up with where this is not an appropriate investment. So that's one really important question. How rosy are they being about this? Similar to that, are they creating safe harbors? Are they essentially saying, you don't need to worry about your legal liability if these are the kinds of investments you're putting on the lineup? That would be very worrying and very problematic. Particularly because, where we do have evidence and of what the administration's thinking in other contexts in this space is that they are very opposed to participant litigation. And the way to think about that is they're very opposed to accountability for the fiduciaries that are charged with these legal obligations and making sure that if something goes wrong, that they can be held accountable. The reality is, if they're not being held accountable, then the person that takes the hit is the individual that's trying to save for their retirement. So there are a lot of reasons to be very worried about this. The last thing that I would just highlight in terms of the Trump 2.0 guidance is that, when you're looking at these kinds of investments, William touched on this, the stats that get thrown around in the glossy presentations, at best, they're looking at average returns, which means that there are a lot of returns that are a lot worse than that. Even putting aside the questions around the IRR and how manipulable it is and all of that kind of stuff, the best case scenario is that there are a lot of investments that are not as good. And the core question here is, are the retail investors, the savers, are they getting put in the good or the bad? And I have my own views on what's likely to happen, and it's very aligned with William. And the part of it that I would emphasize, though, is that this is, again, thinking about the context, it's coming at a time where I would say this is true of the SEC, but certainly at the Department of Labor, the regulator that's charged with overseeing these kinds of decisions and making sure that they're happening in the best interests of retirement savers, that agency has been decimated. They've lost about 30% of their enforcement staff. And so when you think about this combination of, we're going to loosen the rules, we're going to make it easier for these people that can't sell assets otherwise to now put retirement investors, retail savers, in the driver's seat here. And we're going to do that in the context where the regulator is not really going to be able to look after the system. There are a lot of reasons to be very worried about what's about to happen. And with that, I'll turn it over to you, Oscar.
Thank you very much. We are also thrilled to have Professor Lenore Palladino from UMass Amherst Department of Economic and School of Public Policy, where she focuses on political economy of corporations and finance. And prior to joining UMass, Professor Palladino was at the Roosevelt Institute. Professor, thanks again for being here. In addition to risks to individual retirement savings, there can also be systemic risk implications. You have a paper talking about a recent paper talking about private credit, and I was wondering if you can talk a little bit about how that activity might be turbocharged and with access to 401k money.
Yeah, thanks for having me, and thanks for everyone who's watching today on this Wednesday afternoon in August. It's really important that we get educated about what's happening. So let me zoom out for a second. I'll try to be really brief. I think that we need to see the transformation that's happening right now in finance as completely systemic. The unregulated financial markets now dominate. So we're talking about private equity, venture, hedge funds, but we're also talking about private credit funds, which I'll talk about in a little bit, and also crypto and all the other forms of fintech. All of this together is our new unregulated financial system. We need to remember that, for example, 30% of households own crypto in the US. That industry is also coming for individual retirement and household assets and pensions. The point that I want to make is just that unregulated financial markets are now the financial markets. That's a big change. And I'll just make also a language point. I'm saying unregulated rather than private because I think that saying private financial markets doesn't sound that bad. right? If you know this history, the private equity industry renamed itself private equity after the leveraged buyouts, catastrophes in some ways of the 1980s, and the name private equity stuck. I think saying unregulated markets makes it much clearer to, everyday people that what's going on and why these markets are distinct. And what we're seeing with the rise of unregulated finance is a loss not only of substantive regulation, but at the basic level, any data collection whatsoever that we as the public can have access to tell what's going on. So we need to understand this systemic change in order to be motivated to be ready with structural substantive solutions when we have some political will in the future. Let me mention really briefly just two types of risks. I don't have the crystal ball. I wish I did. Where will systemic risks come from? It's hard to know. The first is just the longer term systemic risk that all of this means that we won't have a strong economy, right? The ostensible purpose of the financial markets is to fund real investment, right? The kinds of productive activities that our non-financial corporations do, producing goods and services, supporting our social and physical infrastructure. So the risk that we're facing is that unregulated finance is getting better and better at buying up and consolidating healthcare, right? Hospitals, home healthcare, hospice. Private credit funds are lending to all sorts of goods and services companies and aren't evaluating whether those companies can pay that money back when tariffs hit and unemployment rises. People work at these companies, right? These big risks of unregulated financial markets is that we won't see any kind of support and we'll see a constant extraction from the economy that we all live in every single day. And then I think secondly, there's specific risks that something goes wrong very quickly in the unregulated financial markets. And this, of course, draws on our history of the Great Depression, as well as the Great Financial Crisis. And I think that private equity's reliance on private credit funds, which we haven't talked that much about today, is another example of where we could see systemic risk emerge very quickly. So private credit funds are essentially investment funds that lend money to operating companies. It's exploded from a niche market to a $1.7 trillion industry, and it's becoming increasingly interconnected with the regulated banking industry. There's a lot of people writing right now about the potential systemic risk, including such notable fearmongers as the IMF, Moody's, the Federal Reserve, right? There's a real sense that this could be coming. This interconnection between private credit and the regulated banking system is creating a risk. There's the risk that we don't have any idea at what interest rates or what terms these loans are being made. We don't know, and we should not trust that due diligence is happening just because asset managers say it is. We should have learned that lesson 20 years ago, right? And we're seeing all kinds of potential liquidity mismatches where the underlying limited partners or institutional shareholders need to get money out at certain times. And as others have talked about today, that may not be possible if some of these deals really go south. So I think that this bigger picture systemic risk and the impacts on, in the long term, on the actual productivity and sustainability and equality in our economy is where real systemic risk lies. And we need to understand the big picture transformation that's happened, but we also need to pay attention to the specific types of short-term, quick risks that we could really see emerging from all different corners of the unregulated financial sector. So thanks.
Thanks so much. And yeah, we'll start using the term for sure. So we'll start to shift gears now to one question that keeps popping up, which is how can we fight back against all of this? So I'd like to introduce Elizabeth Parisian, who is the Assistant Director of Research and Strategic Initiative with the American Federation of Teachers, where she leads the Center for Workers' Capital. She has worked in the labor movement for over a decade as a strategic campaigner, researcher, and communicator on a number of corporate accountability campaigns. Welcome, Elizabeth. Thanks for being here. And can you talk a little bit about organizing approaches to protect workers' capital from risky private market and private equity investments?
Absolutely. Thanks, Oscar, and thanks to AFR for hosting this. Thank you to everyone who's on the call and my esteemed fellow panelists. Really happy to be here. This is a really important discussion. So the AFT has done a lot of work on this because the majority of our 1.8 million members participate in defined benefit pension funds. And defined benefit pension funds are one of the largest sources of capital for the private equity industry. In some cases, our members sit on pension fund boards. They oversee these funds. They oversee their fellow workers' deferred wages. And, over the last 10 to 15 years, we've heard from so many of our trustees that they have concerns, right? And other panelists have done a really good job of really speaking to the many, many risks. So I won't go over those. But for our members' pension funds, one of the fundamental problems is lack of transparency, right? If the pension fund trustees don't know how much they're paying in fees, beneficiaries themselves don't know how much they're paying in fees, right? If they don't know what the returns really are, what the portfolio companies are really doing, they can't assess the risks, right? And that's part of their job, right? So one of the things that we've done over the years is we've produced a series of reports that have shined a light on many of these issues, right? And some of these reports we've done in partnership with the AFR and other organizations represented, other unions and organizations represented on this call. Just last week, we put out a report showing that honestly, private equity might not be worth the risks for many investors. We've looked at labor issues associated with PE. So step one, we do the research, right? Often in collaboration with other folks who are working on this. Step two, we educate our trustees and our members, right? Part of the spell that PE casts on pension funds is it kind of presents itself as too sophisticated and complicated for regular people like teachers and public employees. So we do the work to demystify that and really arm our trustees and our members with questions that they can ask. We work with them to pass policies at their funds or even at their state legislatures around fee disclosure, putting labor policies in place, right? Like we work with them to actually put guardrails on the industry through their public pension funds. We also work with state financial officers, legislators, right? I mean, there's a lot of folks, and when we have these concerns, that share these concerns, and when we get together, we can curb some of the worst abuses. Most of our members have take part in public pension funds, but some have 401ks, right? And just as others have spoken about on this call, the risks there are even greater. So again, we're going to apply the same model, right? We're going to raise these issues publicly. We are going to do the education with our members about what the risks are, and and when needed, mobilize them to ask questions and to get the information they need, and to hopefully make it so that their retirement money isn't put at risk in private equity the way public employees already is. I'm going to go ahead and stop there because I know we're running short on time.
Thank you so much. And last but not least, it's my pleasure to introduce Erin Markiewitz, Senior Corporate Analyst in the AFL-CIO's Capital Strategies Program and a Union Trustee of the AFL-CIO Staff Retirement Plan. She is also a member of the U.S. Asset Owners Advisory Council of the Council of Institutional Investors, and holds a PhD in economics from the University of Michigan, where her research focused on corporate finance and industrial relations. Thank you so much, Erin, for joining us. And can you tell us a little bit more about what the AFL-CIO is doing to fight against the industry push to open up private markets to 401ks and retail investors more generally?
Absolutely. Thank you, Oscar. And I want to start very quickly. Thank you to all the esteemed panelists and everyone on this call and our partners in moving economic justice forward in this dark moment. Some background. The AFL-CIO is a federation of 63 national and international labor unions representing roughly 15 million members. Our members, like many American families, share deep exposure to U.S. capital markets and mounting retirement insecurity. But I want to just start very quickly by talking about a group facing mounting insecurity, private equity fund managers. We've heard a lot about the insecurity that they feel at this current moment, and they are feeling it. I want to dig into one key piece that needs repeating. Professor Birdthistle mentioned this by another name. continuation funds or secondary funds, which are exploding as mature PE funds sell their portfolio companies to other PE funds managed by the same manager. Think about it. If PE fund valuations are increasingly dependent on new PE fund money being invested, what could possibly go wrong? We believe that this is clearly a game of musical chairs, and at some point the music will end and PE investors will rush to find a seat. Only we don't expect there to be enough seats for everyone. And to keep this game going, PE will keep trying to bring in new players. Either it's going to be 401k, it's going to be other people. They're really trying to bring in as much capital as possible to keep this game going. Needless to say, the PE general partners, when the music ends, will have all found their seats. And they want us, working people, to be left holding the bag. Now, I want to just quickly mention some stats that haven't been mentioned yet. Private equity buyout funds have raised 23% less capital this year globally. This is not just a US issue. In the last year, and fundraising continued to decline throughout 2024. The music is slowing down. And in our view, adding private equity to 401ks is possibly risks offloading some of these underperforming investments, as others have said before. Now, we know that private equity is illiquid, it's not transparent, and it's very expensive. I want to discuss that, for pension funds, these sophisticated institutional investors hire teams of lawyers and financial experts. You can't do this on your own to negotiate the terms of and monitor these investments. And it's hard for these institutional investors to even figure out the conflict of interest, the hidden fees, and determine the market value of the portfolios that they hold in private market investments. I want to just make it very clear that we supported President Biden's SEC Chair Gary Gensler's attempts to bring PE rules back into alignment with common sense policy that would have improved transparency and reduced conflict of interests. Now the Trump administration is trying to throw working families to PE sharks, and it would be simply unconscionable to allow that to happen. But we want to be very clear. The fight against this and other attempts to strip workers of their retirement security cannot be piecemeal. The stakes are too high to let this fight get separated from the broader one at hand. And I just want to be very clear that 40% of all Americans don't have money invested in a retirement savings plan, whether that's a 401k, 403b, or IRA. And that number rises to 60% for Americans without a college degree. 80% of all adults are either worried or extremely worried about the solvency of Social Security. And who can blame them? Since Trump unleashed DOGE to attack federal workers in January, the Social Security Administration announced cuts, eliminating 7,000 jobs on the administration. Lines formed outside their offices nationwide due to overburdened staff and frequent disconnections from the agency's phone lines. Just last week, Trump fired the commissioner of the BLS, the Bureau of Labor Statistics, because he apparently couldn't tolerate the truth about his economic policies and the resulting slowdown in job growth. This is the context that private equity managers and other private fund managers are seeking to pose a solution by offering access to illiquid and untransparent investments. Those of us who are fortunate to have the means to save for retirement in this economy deserve to have investment opportunities with low fees, high transparencies, and safeguards against conflict of interest. This is common sense, and the AFL-CIO has repeatedly fought for common sense capital market regulation. This includes advocating for strong fiduciary protections, private market fund regulation, and limits on marketing of fee-laden and risky private market investments to unsuspecting 401k investors. But I want to be clear, it doesn't stop there. And we're looking forward to joining you all in the other fronts of this fight. And with that, I'll turn it over to Oscar to continue with the discussion.
Thank you so much. So I know we are at time, but if we can stay for a few more minutes and cover some of the questions that we got on the chat. There are some questions repeatedly about resources and research about the disappointing returns, high fees, and lack of transparency. I think Aditi Sen from AFR is putting some of those resources in the chat and linking to several reports, including the most recent report that AFT and AFR put out last week. There is also a question about whether this executive order would apply only to 401ks or also to 403b plans. Ali, is that something you can share some light on?
Yeah, I mean, I don't know the executive order. We haven't seen a leaked draft or anything like that, but as a legal matter, yes, it very well could apply to 403Bs.
Right. And we have a little more long format question that says, assuming this happens because the entire industry is pulling for it, what tactical ideas does the team have for exploiting opportunities opened by this change? In other words, state level policy for better transparency, require fiduciaries to bargain over fees, perhaps collectively at national level, though not doubt might draw antitrust challenge, and generally use this as a driver for more transparency in the industry. Thoughts on this or any other ideas? So, this is kind of like what can we do about all of these? So I'll open it up for the panel and see if there's any takers.
I'm happy to start, and I'm
Please.
sure others have plenty of thoughts on this. I mean, I think, part of the bottom line here is that just using private equity as an example, when you're investing in private equity, it's almost always good for the private equity firm. It may or may not be good for the saver. And, part of, I think, what this is going to look like over the next several months, because there'll be public comment periods and everything else. So I want to focus on that part of the fight first, because I think shaping what ultimately comes out from the administrative agencies is important, making sure that they're balanced, that they're expressing the appropriate degree of caution, that they're helping fiduciaries that need to make these decisions with guidance. I think those things are all important. I will also say that from my perspective, if this is the direction that ultimately the administration goes in, then I think that puts a lot of pressure. And I have like multiple SEC experts here who will correct me if I'm getting over my skis. But I think that puts a lot of pressure on the entire kind of private market concept and framework. And I think what ultimately you will then see is that private market regulation to make it look a lot more like what you see in the public market side, because it's kind of untenable otherwise.
Thanks, Ali. Anyone wants to add anything? I don't think we have time to read any more questions, so I'll just, open it up to anyone who wants to jump in. Anything you forgot to mention, or?
I'll just mention that I think, if this executive order goes through and we're seeing more and more asset managers, et cetera, offering private equity as part of 401k plans, usually it's going to be as part of a target date fund where investors won't be choosing it. They won't even know it's there. I think, to protect state retirement savers, I think maybe need to focus on the trustees of the various 401k plans, from the largest employers that have thousands and tens or hundreds of thousands of employees to the smaller ones, just to let them inform them about the risks, the fees, the litigation risks especially. And then I think the fear of litigation is probably going to be the only thing, not the only thing, but one important factor that might slow this train down.
Thank you so much, Professor Jones. I just wanted to say once again that, our retirement system is supposed to serve workers, and our 401k should remain a source of security for workers and not act as a bailout fund for Wall Street riskiest bets. With that, big thank you to all of you for joining us today. Big thank you to all of our speakers for being so generous with your time. And please stay tuned for more information on all of these from AFR and our partners. And please reach out to us directly if you like to talk more about ways to contribute and join in this fight. Thank you all very much.